Hi, this is a continuation video explaining the concept of provisions of Indian Partnership Act 1932 relating to interest on capital. While we saw journal entries in the previous video, in this video we will demonstrate the same concept by using ledger accounts. Let's go to the example. Example, A and B have capitals of rupees 4 lakh and rupees 2 lakh respectively, and interest on capital is to be allowed at 6% per annum. Their profit sharing ratio is 2:3 and the net profit, that is a profit before the interest, for the year is rupees 30,000. Show the relevant account to allocate interest on capitals. Case 1 says, if the partnership deed provides for interest on capital, and case 2 says, if the partnership deed provides for interest on capital as a charge. First, let's calculate the amount of interest on capital for each partner. Interest on capital in the case of A, (6% of rupees 4 lakh, which is 24,000), and for B, (6% on rupees 2 lakh, which is rupees 12,000). The total IOC is equal to rupees 36,000. Let's go to case 1. The case 1 says the partnership deed provides for interest on capital. Now, the deed is providing for interest on capital at 6%, but it does not say whether it's a charge or appropriation. So we'll have to treat it as an appropriation and debit the interest on capital to the profit and loss appropriation account. So let's prepare the relevant ledger account, which in this case is profit and loss appropriation account. Profit and loss appropriation account for the year ended 31st March 2019. Left side debit side, right side credit side. On each side, particulars, inner column, outer column. Again on the credit side, particulars, inner column, outer column. Let's bring down the profits as per the profit and loss account. Net profits by profit and loss account for the net profit brought down. 30,000. Now we need to allow interest on capital, but what we see is that the total interest on capital is coming to rupees 36,000, whereas we have a net profit of only 30,000. Appropriation can be made only to the extent of profits available, so we can allow interest on capital only to the extent of 30,000. the ratio in which we will allow this interest on capital is I'm writing the working note down at the bottom. Ratio of the IOC of A and B. IOC of A is to IOC of B, which in this case is 24,000 is to 12,000. In other words, it is 2 is to 1. So we will allow interest on capital to interest on capital account for A is equal to 30,000 into 2 divided by 3, and for B it is 30,000 into 1 divided by 3. So A gets interest on capital of 20,000, whereas B gets interest on capital of 10,000, and the total of interest on capital allowed is 30,000. So we've completed the first case where we treated the interest on capital as an appropriation and debited it to the profit and loss appropriation account. But since there were insufficient profits of only rupees 30,000, we could give interest on capital only to the extent of 30,000, and this was given in the ratio of the appropriation to be made. In this case, the ratio of interest on capital of A is to interest on capital of B. Let's move on to case 2. If the partnership deed provides for interest on capital as a charge. Case 2. The interest on capital is to be considered as a charge, so we need to debit the amount to the profit and loss account. So the relevant account to be prepared is profit and loss account. Let's go ahead, prepare profit and loss account. Profit and loss account for the year ended 31st March 2019. Left side, debit side, right side, credit side. On each side, particulars, the inner column and the outer column. Again on the credit side, particulars and the inner column and the outer column. We will bring down the profits by profits brought down. The amount of profits brought down is 30,000. Now the nature of charge is that irrespective of whether there are profits or not, we need to allow the charge. So we need to give interest on capital to A fully rupees 24,000, and for that of B rupees 12,000. So let's allow interest on capital to interest on capital account. For A it is 24,000, and for B we'll give 12,000, and the total IOC allowed is 36,000. Now we are left with a loss of rupees 6,000. There is no interest on drawings, so the loss has to be directly transferred to the partners' capital accounts from the profit and loss account itself. So we'll make the transfer by loss transferred to partners capital accounts, assuming the fluctuating capital method. The amount of loss the total loss is rupees 6,000. The ratio of the partners profit sharing ratio is given as 2:3. So A gets 6,000 into 2 by 5, which is 2,400, and B gets 6,000 into 3 divided by 5, which is 3,600. So we've completed the second case also, where the interest on capital was to be a charge. Therefore we debited it to the profit and loss account, and though there were insufficient profits, we allowed interest on capital of 36,000 fully to A and B, and the resultant loss was directly transferred to partners capital account from the profit and loss account, because there was no interest on drawings. So in this video we understood concept of provisions relating to interest on capital, the three cases, by means of ledger accounts.